The money printer isn't just slowing down, it's being unplugged. And if you own stocks, crypto, or real estate right now, you need to hear this. Kevin Worsh. Remember that name, because in 2026, this one man could become the biggest threat to your portfolio, your retirement account, and possibly your home's value. Here's what's happening right now while you're watching this video. The Federal Reserve, the institution that literally controls the flow of money in America, is about to undergo its most dramatic transformation in decades. And the guy they want to lead it, he's the exact opposite of the easy money Fed chairs we've gotten used to. Think about it. For years, whenever the economy hiccuped, the Fed's answer was simple: print more money, lower interest rates, bail everyone out. Your 401k went up, Bitcoin went to the moon, real estate prices doubled. Everyone felt rich. But that party is ending, and Kevin Worsh isn't just turning down the music, he's kicking everyone out and locking the doors. In the next 10 minutes, I'm going to show you exactly what's coming, which of your investments are in danger, and most importantly, how to protect yourself and maybe even profit from this massive shift. Let's dive in. Part 1. Who is Kevin Worsh, and why should Wall Street literally panicking about this guy? Okay, first things first. Who is Kevin Worsh, and why is Wall Street literally panicking about this guy? Kevin Worsh isn't some random economist. From 2006 to 2011, he served on the Federal Reserve Board of Governors. He was there during the 2008 financial crisis. He watched the money printer get turned on. And here's the thing, he hated it. While other Fed officials were celebrating quantitative easing and emergency rate cuts, Warsh was the guy in the room saying, "This is going to create massive problems down the road." He warned about inflation. He warned about asset bubbles. He warned about the dangers of keeping interest rates too low for too long. And guess what? He was right about all of it. Fast forward to today, inflation hit 9%. The stock market became completely divorced from reality. Companies with no profits had billion-dollar valuations. Real estate prices went absolutely insane. Bitcoin hit $69,000. And why? Because the Fed pumped trillions of dollars into the system. Now here's where it gets interesting for you. President Trump has nominated Kevin Worsh to be the next Fed chair, and if he gets confirmed, which is looking increasingly likely, everything changes. See, most Fed chairs care about two things: keeping unemployment low and keeping the stock market happy. They'll do whatever it takes to avoid a recession, even if it means printing money we don't have. But Worsh, he's different. He's what Wall Street calls a hawk. He believes in something called monetary discipline. Fancy words that basically mean no more free money, no bailouts, no more easy credit. He's publicly stated that the Fed's balance sheet, which ballooned from $800 billion to over $9 trillion, needs to shrink dramatically. He wants interest rates to reflect real economic conditions, not artificial Fed manipulation. For everyday Americans who've been investing in stocks, crypto, or real estate thinking prices only go up, this is a wake-up call. Because when Warsh takes over, the game changes completely. Part 2. From easy money to the liquidity drain. All right, let me explain what's actually happening here in terms that make sense. You know how when you want to buy a house, you need a mortgage, and when that mortgage has a low interest rate, you can afford a bigger, more expensive house. That's basically what the Fed has been doing for the entire economy. For the past 15 years, the Fed used something called quantitative easing, or QE for short. Here's how it worked. The Fed literally created new money out of thin air and used it to buy government bonds and mortgage-backed securities. This pumped cash into banks, which then lent it out at super low rates. More money flowing meant higher prices for everything. Stocks went up, real estate went up, even Bitcoin and crypto went parabolic. Because when money is cheap and abundant, people invest in anything. But now, we're entering what Warsh calls liquidity drain. Translation, the Fed is going to remove money from the system. Instead of buying bonds, they're letting them mature without replacing them. Instead of pumping liquidity into markets, they're draining it out. Think of it like a bathtub. QE was turning the faucet on full blast. Liquidity drain is pulling the plug. And here's the scary part. We've never done this at this scale before. The Fed's balance sheet is $9 trillion. Warsh has suggested it should be closer to $2 to $3 trillion. That means potentially $6 trillion of liquidity could be drained from the financial system over the next few years. What does that mean for you? Well, when there's less money chasing the same assets, prices fall. It's basic supply and demand. Your stocks could drop, Your home value could stagnate or decline, and speculative assets like crypto, they could get absolutely demolished. We're already seeing it happen. Bitcoin dropped from $108,000 to under $95,000 just on rumors of Warsh's nomination. Imagine what happens when he actually implements these policies. This isn't fear-mongering. This is economic reality. The liquidity that inflated your portfolio is being systematically removed. Part 3. Which assets survive and your action plan. All right, here's the good news. Not everything gets crushed in a liquidity drain. Some assets actually thrive in this environment. Let me break down what tends to survive and what doesn't. What's at risk? High-growth tech stocks with no profits? Danger zone. These companies relied on cheap borrowing to stay alive. When interest rates rise and liquidity dries up, they're in trouble. Cryptocurrency and speculative assets? Extremely vulnerable. Bitcoin, Ethereum, and especially meme coins were fueled by excess liquidity. Without it, expect massive volatility and potentially 50 to 70% drops. Overpriced real estate in secondary markets? At risk. Properties that doubled in value during the pandemic purely because of cheap mortgages will face downward pressure as rates stay elevated. What survives? Value stocks and dividend-paying companies. Businesses with strong cash flow, low debt, and actual profits will weather this storm. Think utilities, consumer staples, healthcare. Real estate in prime locations with strong rental demand. While secondary markets might struggle, major metros with job growth and housing shortages will hold value. Treasury bonds and fixed income assets. When liquidity drains, boring safe assets become attractive again. Government bonds, CDs, and high-yield savings accounts suddenly make sense. Commodities and hard assets. Gold, silver, energy. These tend to hold value when financial assets struggle. Your action plan. 1. Don't panic, but do reassess your portfolio. If you're 100% in crypto or speculative stocks, you're overexposed. 2. Build cash reserves now. In a liquidity crisis, cash is king. Having 6 to 12 months of expenses gives you options. 3. Diversify into defensive positions. Add some value stocks, bonds, or even precious metals to balance your risk. 4. If you're buying real estate, focus on cash flow, not appreciation. Rental income will matter more than hoping for price increases. 5. Stay informed. The Warsh Fed won't happen overnight, but the market will react before policies are implemented. This isn't the end of investing. It's a reset, and those who prepare will come out ahead. If this video helped you understand what's coming, smash that like button and subscribe so you don't miss our next breakdown on protecting your wealth in 2026. Drop a comment telling me what percentage of your portfolio is at risk, and share this with anyone who needs to hear this warning. Stay smart out there.